Welcome to our High Rock monthly video for July. Today, we will address how financial markets performed last month and how this may impact your portfolios in the near term. And we'll update you on any key adjustments to our models and special mandates and how our managing risk first philosophy will be the key to maintaining growth in these uncertain times. I am Scott Tomlinson, and with me on the call today is Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division in 2015, and we have celebrated our 10-year anniversary in April. Let's start with a recap of June. All U.S. equity markets bounced back, and that dragged global equity markets higher, and most other equity markets were up, and that certainly helped balance portfolios in the month with positive growth. The only thing lagging are Canadian bonds. I don't know if you've got any color you want to throw in here, but that's where we're at.
Yeah, what else do you say? I mean, it was a vicious rally over the past month and a complete turnaround from where we were. Maybe we'll see some of that, through some of those value charts that you have, Scott, as to where we were back in winter and spring.
Yeah, and just also we've sort of been monitoring how the Canadian dollar has performed. So it continues to defy gravity, as it were, despite the uncertainties in the tariff world. And I'm assuming, and you may be able to put color on this as well, but that it's mostly declining U.S. dollar relative to all major currencies at this juncture, right?
Yeah, I would agree with that. I mean, and most certainly the fiscal situation in the U.S. has really deteriorated dramatically. I think it was bad, what's called debt distribution for U.S. Treasuries, i.e. they had a lot of short-term debt during the Biden years. They didn't really during the early COVID days when they were funding massive deficit funding for COVID. They didn't term it out like the Europeans did. So they have a lot coming due, and we've talked about that before. But now putting this, whatever the heck it's called, this big, beautiful bill on, it's just, I think there's an enormous, this is not an equity issue. I think companies are in better shape than the federal government in the US and similarly in Canada. And I'll talk a bit more about that. But yeah, I'm pretty surprised the Canadian dollar and the Canadian stock market has done as well as it has. And the US dollar is actually starting to improve here over the last 24 hours. So it may have hit a bottom, in which case the Canadian dollar may have hit a peak.
And as it is, or as we have seen one half of the fiscal year go by, I thought we just have a quick look at how things have evolved over the course of that period of time. Clearly, we can see what happened after Trump's tariff liberation day occurred in April, and financial markets were thrown into a complete tailspin in many ways, and how we have somewhat bounced back, although there's still loads of uncertainty about how tariffs will impact economies and inflation. And it's clear that assets have moved into safer environments. Gold, certainly one of them, not bonds, as you've talked about, because bond markets are going through other gyrations, but international equities as opposed to U.S. equities. So we've definitely seen a move out of U.S. equities, and even though U.S. equities have recovered somewhat, still not to the degree that we've seen international equities go higher this year. So all in all, balanced portfolios are positive, and that we can look at. They're up about 3.3 according to the Morningstar averages. Now these are just average, the average balance fund that Morningstar covers, thousands of funds, but the average is about plus 3.3. So our clients can make comparisons to their portfolios to get a relative idea of how their growth has performed over the course of the year. It's basically average growth, as you can see from the 5-year number. 6.37 is average growth for the last 5 years, and we've seen some significant moves in volatility, certainly in 2022 as part of that. So it's a representation that you can make comparisons against your portfolio, and always as we look at how we manage for better risk-adjusted returns as a function of all of it. It is certainly different for each client, their experience, their strategy, and we encourage you to contact us if you want to have an update or discuss your strategy and your goals. That's our long-term focus, of course, is your goals and your plan and your strategy. Okay, so I'm going to jump into our global equity model. As Paul mentioned, valuations, when we're have buying hats on, our metrics, we look at value, earnings relative to price. And as you can see, historically, when prices are below the expected longer term earnings, so we're looking at this chart here, and it's 12-month forward earnings is the dark blue line. So when the light blue line, which is the S&P 500 prices, gets underneath that on a term basis, then we see value, as we did through the 2022 period, and now earlier, or in April of this year, we saw value. So those are the red circles. Currently, though, valuations are showing that equity prices, especially in the S&P 500, are expensive. So what we do is we look at other metrics. We look at the greed and fear index, fear and greed index, and again, we see that the market is experiencing more greed relative to what we saw in April when we were buying, when there was fear. So at this juncture, as far as our equity models are concerned, as we rebalance, we will be taking sales of equities that have overweight positions, and that's the justification for that is overvaluation and the fact that there's more greed than fear currently in markets. Paul, on that note, I'll turn it over to you to talk about our tactical model.
Okay, thanks, Scott. There were no real trades. I'll just highlight one thing across the month. Our largest single position in the tactical model, which is Source Energy, the sand fracking business. This thing, I've mentioned it before, is it's cheap, but there are a lot of cheap stocks, certainly in the energy space, or energy-related oil field services, they're called. In this case. So this stock, it peaked out in the earlier part of the year at $18.50 roughly, and got down to $6.80. And today it's back up at $14.20. And across the month of June itself, it was up about 16%, but it's had a almost 100% move from the bottom, and that just gives you an idea as to how volatile this thing is. So I still really like that position. So that certainly added value across the month, especially for those with the larger weights in the tactical model. Gold and silver are in the tactical model. Scott, you showed a couple charts on both the past month of June and year to date, how well gold and silver has done. Just on gold itself, you mentioned that I don't think we can look at government bonds, and let's just talk about Canada and the US Treasuries and Canadian government bonds, as a vehicle that we did in the past as a flight to quality or a safety vehicle. I'm I think the fiscal situation in both countries has deteriorated so dramatically. We don't even know what the number is in Canada yet, other than the C.D. Howe Institute yesterday published a report stating that the deficit this year, 25-26, could be at around 92, $93 billion, so damn close to a $100 billion deficit, which we were expecting at the time, 3-4 months ago, at 40 billion, then 60 billion, now could be at 93 billion. And then every other deficit would be around 70-75 billion every other year of the term for the Carney government. These are horrific numbers for the country and for our government debt. So it's something I'm worried about. And one of the things that we actually, I'll if you want to switch the slide to fixed income now, Scott, I'll just keep talking about, you can see we have that blue pie, blue part of the chart, slice of pie is government bonds. But quite frankly, and government bond yields across the month were largely unchanged, so they didn't really affect our performance. Investment grade improved, and the spreads have continued to tighten, as they have for, quite frankly, slowly for multiple years. And same with high yield bonds. I mean, high yield bonds in both Canada and the US are trading at, all-time tight spreads. And why is that? Well, because quite frankly, a lot of these corporate issuers, both in the high yield space and the investment grade space, they look better on a credit basis and credit metrics than the government does. So, for instance, and I was telling high yield investors this, like we have some high yield issuers in the energy space that have zero net debt leverage. Like they have nothing. Like the worst one we own has got 1x leverage. To give you an idea, most other non-energy related non-energy issuers would be out at 3-4x leverage. And most of the energy bonds we own, those companies have, like, call it zero, half a turn of leverage, 0.5x leverage. It's de minimis. They're in great shape. They have great balance sheets. Some investment grade issuers are much the same. So that's part of the problem with, in my opinion, with the government bonds. And gold is doing what it should be doing. It's worried about the fiscal situation. There's been such massive devaluation of our purchasing power or the currency over the last 30 years because of these large, massive federal deficit situations that it just destroys the value of your buying power, your currency. So gold is going to, in my opinion, keep improving. And quite frankly, and not that we own any and we're not really involved, that's why Bitcoin's done what it's done. It's gone from whatever, the last number of years, from 6,000 to 106,000. So anyway, that's my, and preferred shares, I'll just finish off that last slice. They actually improved across the month as well, which is good. So that's my explanation and rant for the month.
And I think you pretty much covered our high yield and preferred share mandates to a degree, but if there's anything additional you want to throw in there, feel free.
Yeah, no, I think that does cover it. I mean, prefs had another solid month. High yield just kind of steady as she goes. So nothing really to add other than, yeah, the spreads are tightening, and I don't think you can look at spreads. You need to look at credit quality, which is something we obviously do.
Yep. All right. Well, thank you. And as always, we want to thank all our listeners for taking the time out of their busy schedules to join us on this call. We'll be back with our next update at the beginning of August. So until then, on behalf of my colleagues, Paul and Diane, we want to wish you all the very best.